Okay, absorption versus variable costing. We're going to do a couple examples so you get a better idea of what's going on and how we handle the accounting side of it. Start out with a couple simple exercises. In exercise 6-1, you have a company in, I believe this is Bali in Indonesia. They produce handcrafted Balinese musical instruments called a gamelan. Okay, or I'm not sure how you pronounce it, but anyway, it's similar to a xylophone. So this is what these instruments look like. I looked it up on the internet, put a picture on there. They sell for $850. Okay, and it does have a US price tag on it. I'm not sure why. I suspect in Bali they don't use dollars, but maybe that's a conversion. Okay, so the selected data for the company obviously being from this little table over here, and you see that they have 0 units in their beginning inventory and they produce 250 during this period. So remember that one of the concepts behind absorption costing is that you're going to take the manufacturing overhead cost, the fixed cost, and you will divide it by the units produced, not those sold. The number of units sold is actually going to go to the income statement and doesn't really have a lot to do with the production side of it. Okay, when you put together the income statement, you will have to calculate a cost of goods sold though. Okay, so keep that in mind. So we started with 0, produced 250, we sold 225, so obviously you can see that inventory increased from 0 to 25 units. Under variable costing, you got materials, labor, you got variable overhead. We do have variable selling and admin, and here I'm going to caution you that selling and admin is never a product cost, will never travel through the inventory account and stay on the balance sheet until we sell it. Okay? Selling and admin, whether variable or whether fixed, they are always a period cost. So you always expense them in the period incurred. All right, so my technique, okay, in which I encourage you to adopt, is basically to create 2 columns to do your product costing. You do this, you'll keep things pretty straightforward and clear. You're going to take the information they provide you and you're going to say, oh, my material cost, sorry about that, is 100. And then your variable material cost will be exactly the same. I'm just getting that right from here. Again, the $320 of labor, you're going to put it on both sides because under absorption costing you have direct materials, direct labor, variable overhead, but you also include the fixed. Variable costing obviously will only capture variable cost. It cannot have fixed cost, then it would not be variable costing. Okay, so the computation of this 240, it was not given to you. So you have to go to your manufacturing costs, $60,000, and you're going to divide it by the number of units produced, this 250. It comes out to $240 for every unit. So we plug that in under absorption costing only, hit the sum command, add them up, $700. Sum command, add up the variable costing. These costs represent how the cost would flow through the balance sheet. A finished unit under absorption costing, generally accepted accounting principle, is on the balance sheet at $700 and stays there until it is sold. Once it's sold, it moves to cost of goods sold. Under variable costing, or again for internal management purposes, we're only putting the 460 on the books and we move it to the income statement to measure our profit when we sell it. Okay, now there's a difference between the two and is a very significant difference. The difference is going to be that $60,000 of fixed manufacturing overhead. Under variable costing, we expensed it all. Under absorption costing, we actually first let it go through the inventory account, and then as we sell it, we move it to cost of goods sold. So if I think about the 2 methods and what's different, essentially I need to know, well, what happened to my inventory? If inventory stays exactly the same, meaning whatever I produced, I sold, then essentially the overall cost will be exactly the same between the absorption costing and the variable costing income statement. Everything will be the same, and we're going to show you that in some illustrations. But what's different is when inventory increases from 0 to 25 units is an increase. That means under absorption costing, I moved part of that $60,000 to the balance sheet, and it is still sitting on the balance sheet for those 25 units that I didn't sell. But under variable costing, I expense the entire 60,000. So you can see, or should be able to grasp, that absorption costing will show more profit whenever inventory increases. Okay? And that's one of the reasons why variable costing evolved, because managers got, caught on to that really quickly. And managers, especially plant managers, would get bonuses based on the profits of that facility. So the more they produced, the higher their profits. The higher their profits, the higher their bonus. Okay? But then they realized that, you get what you pay for. If we make an incentive for you to make more product, then you're going to make more product. Okay? But that wasn't really what the company wanted. You know that we follow more of a just-in-time inventory method. We don't want to overproduce. We want to produce what the customer wants to buy. Okay, so how do I use this data that I just put into this chart? The very simplest question, and coming up on the exam as well as quizzes and stuff, is what will the cost per unit be under absorption costing? Well, we just calculated it at $700. What is it under variable costing? It's going to be $460 per unit. The difference, the $240 per unit, that is the fixed manufacturing overhead. Okay, so very simple first problem, but that's the first stage of what you're actually working on. Okay. Now, part 2 here is actually a continuation of the same kind of problem. Here is where you see where the significance of that difference of $240 actually comes into play. That difference is going to result in a difference in my income statement under the absorption costing income statement versus a variable costing income statement. So the data above here is exactly the same as in the prior illustration. We had the $100 of material, $320, $40, and then I added $240 to come up with a total of $700 for the absorption costing. Okay, so here you see an income statement. And again, if you look at what happened here, the $191,250, if you recall, they told us we sold them for $850 a piece. Okay, in the original scenario, okay, we sold 225 units, so 225 times 850 is where the 191,250 came from. The cost of goods sold here is going to actually be that absorption costing, cost of goods sold. You have 225 units, and you got to multiply it by that $700 per unit of cost. So you can see that I just came up with the $157,500. And of course, gross margin being the difference between the two. And notice how they got the income statement selling and admin cost. Selling and admin came from $20,000 of fixed cost, plus you had to add $20 for every unit. And remember, this is based on what you sold. So think of this as like a commission. The 225, okay, is the number of units you sold. The $20 is the variable cost related to selling and admin. Okay, so adding those two together, you're going to get $24,500. Okay, so here's your income statement. So what do you have to do in this problem? They say, well, we want you to figure out the net income under variable costing. So we already have it under absorption. They need to figure out under variable. Now, I could tell you what we had just said from a recap standpoint. When inventory does not change, inventory level does not change, then your absorption costing net income will equal your variable costing net income, NI net income. Okay, when inventory, I should write it all the way down, inventory increases, when inventory increases, that $240 of fixed manufacturing overhead cost is actually still sitting on the balance sheet. So under that scenario, absorption, I'll just abbreviate the same way, costing net income will be greater than variable costing. And again, the reason is that variable costing took the whole $60,000 and expensed it like a period cost, considering it a cost of capacity. Under absorption costing, that $60,000 was divided over all 250 units that you made, so it went onto the balance sheet for 250 units. But when you sold 225 units, the material, the labor, and the overhead cost related to 225 units flowed down to the income statement as cost of goods sold. So only for the 225 units, the difference, okay, obviously material and labor is under both systems, but and the variable overhead is under both systems in the costing. The only difference is what happens with that fixed manufacturing overhead. So if absorption costing net income is greater than variable costing when inventory increases, then the reverse is true. Okay? When inventory decreases, that means you have to pull down even more cost than the 60,000 period cost. Okay? So then the opposite's going to happen. The absorption costing net income will be less than the variable costing net income. And now I'm going to show you a trick. Okay? This is, we know $240 per unit of fixed manufacturing overhead is associated with absorption costing. If I know the change, okay, 25 unit increase in inventory, okay, so if I multiply the 25 times the 240, 25 units times $240 of fixed manufacturing overhead, I have a $6,000. This difference, okay, is related to the fixed MOH on the balance sheet under absorption costing. Okay, again, remember, all 60,000 moved to the income statement under variable costing. 6,000 of that 60 is still sitting on the balance sheet under absorption costing. So that means that inventory increases, absorption costing will show a higher net income by $6,000 over variable costing. So if I was going to look at the absorption costing income statement, I'm going to predict that the variable costing income statement will be $6,000 less, or $3,250. Okay, so then this walks you through the steps. Okay, there's my $3,250 is how we calculated the difference. I'm sorry, I did that wrong. They asked a different question. They asked how much fixed manufacturing overhead is still in inventory. And that was where we calculated the $25 times the 240 units. Then they wanted me to put together the full-blown income statement. So I'm going to take my cost of goods sold, which is going to be my, under variable costing, okay, we said this was 225 units were what was sold. And if you remember, the cost of goods sold that we calculated was $460 per unit. So that's how we got the 103. Okay. Now, I do have variable admin costs. They told us that variable selling and admin was $20 a unit, and that's the same under both systems. So I'm going to multiply by 20. I'm going to calculate my contribution margin by subtracting the 2. Okay. And then I'm subtracting my fixed expenses. So 3,250, that's what we got, okay? And that's what we predicted it would be, because we knew that the difference was going to be that 6,000 that is still sitting on the balance sheet.